Hi friends, good news. I have a fictitious company called Rahul Pvt Limited and my company needs money to expand. Therefore, my fictitious company is issuing bonds for general public like you. And even better news is that if you invest 10,000 rupees in this bond, meaning you give 10,000 rupees as a loan to my company, then you are going to get 11% fixed interest for the next 3 years. And after the end of the 3 years, my company will pay you back 10,000 rupees that you invested originally. And also this 11% interest is a fixed interest. No matter whether the world goes through recession or whether the RBI repo rate changes, comes up or down, this 11% annual interest remains fixed for the 3 years. Would you buy this bond? Do you think it's a good deal or a bad deal? Pause this video. Let me know in the comments if you think it's a good deal. And also let me know in the comments if you think it's a bad deal. Are you done? Not yet? Pause the video and please let me know your comments. So this could be a good deal as well as bad deal. Allow me 30 seconds to explain. So this could be a good deal because you're getting 11% fixed returns, and if you look at the majority of the fixed return instruments, generally they are likely to give you somewhere around 7% annual returns. So this bond is giving you additional 4% returns on a yearly basis, which makes it a good deal. You may say that, Rahul, what's a big deal? 4% is not a lot. Well, 4% makes a big difference. Have a look at these investors. Investor A, if invest 25,000 rupees per month on a SIP basis and gets 7% returns yearly, after 30 years is likely to build a portfolio of 2.94 crores versus investor B investing the same amount, 25,000 rupees, getting 11% return, which is 4% more for the same time period, which is 30 years, is going to build a corpus of 6 crore 32 lakhs, which is almost double than the investor A. So over a longer period of time, this 4% additional return can really make a big difference in your portfolio. But as they say, every incremental return comes with incremental risk. And that brings me to why this bond could be a bad deal. And here is the explanation. What happens if after 3 years, my fictitious company Rahul Pvt Limited goes bankrupt and is unable to pay you back your 10,000 rupees? This is called default risk in bond investing. Now the billion-dollar question is, what are the chances of defaults in bonds? It depends on a lot of factors that I'm going to explain in this video, but at a very broad level. CRISIL very recently published a data point that in FY24, the default rates were like 2%, meaning that 2 out of 100 bonds have defaulted, and this default rate may change on a yearly basis, as you can see on the graph. And that's where, if you're willing to accept this risk in bond investing is for you. But the biggest problem is that people don't really understand how to go about investing in bonds. And the problem gets compounded because there are more than 400 plus listed bonds on NSE's website at the time of recording this video. More choices bring more confusion. But don't worry, in this video, I'm going to break down bond investing in the simplest and easy to understand language that a 10-year-old will also easily understand. It is not a masala video, but I promise to you that if you continue to watch this video without skipping, you are going to learn something new every 2 to 3 minutes. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a content creator. Before I start this video, a big shout out to the partners of this video, Wind Wealth, that have made bond investing so much easier and simpler for retail investors like you and me. With that, let's get this video cracking. So the first question you need to ask is that which type of bonds you want to invest in. Allow me 1 minute of time. There are various types of bonds. So for example, you have government bonds, for example, GSEC or treasury bills. These bonds are issued by Indian government, and therefore the default risk is literally zero because they're backed by Indian government. However, these bonds offer very low interest rate, maybe around 6 to 7% depending on the market conditions. So these are one type of bonds that you can go and explore. The second type of bond is called corporate bond, which is what I'm going to cover in this video. Corporate bonds are the bonds that are issued by companies, as we saw in the example of my fictitious company Rahul Private Limited, and typically these companies will offer you higher interest rate, and of course these bonds come with default risk, as I explained earlier in the example. Now within corporate bonds, one of the very important point that you need to understand is there are two types of corporate bonds. One is the secured bond and another is unsecured bond. The secured bond simply means that the bond is secured against companies' assets. It is basically the collateral, just like when you go and take a loan against your property or your gold like a collateral. Likewise, with secured bonds, companies keep their assets as collateral. So in case the company defaults, bondholders have a claim on company's assets. Therefore, naturally, the risk is on the lower side. On the other hand, unsecured bonds are not secured against any asset. So in case the company defaults, the recovery for the bondholders may be very, very limited. Now, obviously, that makes unsecured bonds much more riskier than the secured bonds, and therefore typically unsecured bonds may offer you slightly higher interest rates. Now, personally, I do not like unsecured bonds because they come with a higher risk than secured bonds, but of course you're free to explore unsecured bonds. But in this video, I'm going to nail down corporate secured bonds. And the corporate secured bonds that I'm going to explain to you in this video are also going to be listed bonds only, because listed bonds give you a lot of flexibility. Just like a stock is listed on the exchange, these listed bonds are listed on the exchange. Therefore, if you want to sell them before the maturity period, let's say you invest in a bond that has a maturity period of 3 years, but after 1 year you need the money all of a sudden and you want to go and sell that on the exchange, that is entirely possible in case of listed secured bonds. Therefore, what I'm going to cover is listed secured corporate bonds in this video. This is because they offer less risk and more flexibility. With that, let me now explain nitty-gritties of the listed secured bonds using practical examples, and therefore I'm heading to a platform called Wintwealth. You can choose any other bond platform, but I personally like Wintwealth because at the time of recording this video, total 65 bonds with 1600 plus crores of repayments have been successfully done, and this gives me a lot of confidence on Wintwealth's platform. Now on Wintwealth platform, at the time of recording this video, you will see that there are total only 11 live bonds. But if you go to, for example, NSE website, you will find that there are more than 400 plus listed bonds. So why is it that on Wintwealth website there are only 11 live bonds? This is mainly because Wintwealth picks bonds through a rigorous evaluation process. They perform quarterly audits to assess the financial health of these bond issuers, which is very, very important. And more importantly, they themselves invest in these bonds, so they have the skin in the game. For example, if you look at Muthoot Capital January 25 bond, and if you come down here, you will see that Wintwealth themselves have invested 2% in this particular bond. Now, if you want to open your account with Wintwealth, you will find the link in the description or in the pinned comments. And also, please let me know if you would like me to show you how to create the account, how to buy, how to sell these bonds, and how to track your bond portfolio on the dashboard. I'll be happy to come up with a part 2 of this video. But for now, let me demonstrate to you the most important features of the listed corporate bonds that you must understand before you invest in bonds. So I'm on Wintwealth platform here, and I can see total 11 live bonds at the time of recording this video. One thing you will note here is that the minimum investment in some of these bonds is as low as 1000 rupees, and this is phenomenal because this has made bond investing possible for retail investors who have very, very limited capital, and this capital could be as low as 1000 rupees. Now what I'm going to do is I'm going to pick up one of these bonds as an example. Please make sure you do not blindly take that as a recommendation. I'm going to practically explain to you the most important features. So I'm going to, let's say, pick up Muthoot Capital January 25. Let's click on it. What this simply means is that this bond is issued by Muthoot Capital. There are still 19 months before this bond gets matured and your principal gets paid fully. I'll explain YTM, which is yield to maturity, in the later part of the video. But right now, if you see, the minimum investment in this bond is 10,000 rupees for 1 unit. But right now, if you see, the investment amount is less than 10,000 rupees, which is 9948. And if you click on this, you will see why that is the case, because there is accrued interest, brokerage, seller discount, etc. But you are able to get this bond here, for example, lesser than the face value, which is the 10,000 rupees. So when this company pays you back your principal, you're going to get 10,000 rupees in total. Right now, you're investing less than 10,000 rupees. Now, the second point you will note here is that there have been 100% on-time repayments by this NBFC on Wint platform, which is definitely a good track record. But more importantly, if you see, the bond terms and conditions are that you will get your interest paid on a monthly basis. It could be quarterly, it could be yearly, depending on the bond. Here you know that it is going to give you your interest back on a monthly basis. Also here you will note that the principal you're going to get back is on a half yearly basis. So you're not going to get your principal amount after the maturity. In fact, you're going to get it during the maturity period. And in fact, you can come down here and you can see the exact schedule in terms of the dates when you're going to get the interest, when you're going to get the principal. If you click on view more, it will show you the entire schedule. So for example, here you're going to get on 29th of April 84 rupees as the interest roughly, and you get part of your principal, which is 2,500 rupees back. And again, if you scroll down, you will see the complete schedule here. These type of bonds which give you principal during the maturity, part principal during the maturity, they are called amortizing bonds. Important point for you to know. Whether you want to go for it or not is up to you, because if you want the constant cash to come out your way, then amortizing bond may make sense for you. But if you want to get your money at the end of maturity, that is your call. You have to find those bonds, because if you're getting principal paid back during the maturity, then your interest amount will get reduced. For example, here, the moment you get your 2,500 rupees back as principal, your interest starts to come down. So it is your choice whether you want to go for amortized bonds or not. Now, if you come further down below, you will see here some more important details. For example, how many investors have invested in this NBFC, which is 5,400 plus. Wind Wealth has invested 2% in this particular NBFC. You can sell this anytime after buying. That also gives you a flexibility. Now, coming back to more important items, which is if I go to other bond details here, you will see a lot of details that I want you to understand. For example, here you read about the company, you go through the financials of this company in terms of how the net worth has been going up or down, what are the profitability ratios, for example, profitability after tax, etc., etc. But the most important thing that you must understand is the rating of a particular bond. This is extremely important. These ratings are given by agencies, for example, like CRISIL, which is a rating agency. What is the rating given for this particular bond right now is A+. If you come down here, you will see the scales that CRISIL has. For example, AAA is the most safest rating. What is this rating all about? This rating is the confidence of the company's ability to repay its debt obligations. For example, AAA means that there is a lot of confidence, means that this company has given the best rating in terms of its ability to pay back its debt. Therefore, this is considered the most safe here. But because this is the best rating given by CRISIL, the interest rate that you're going to get is going to be relatively lower, 7 to 8%. Next rating comes is AA, where the interest rate now goes up because this is slightly higher riskier than AAA. Then comes the A rating. Here again, the interest rate goes slightly higher, but then this is slightly higher riskier than AA. In my view, typically, personally, I look at A rating. Again, I'm not saying that you also have to stick with A rating. It really depends on your risk appetite. I think A rating, in my personal view, is a good balance between risk and interest rate. But the question comes that, Rahul, what is A plus here? So within a particular category, CRISIL also has a modifier called plus or minus. So A plus is better than A minus. Again, this is a very, very simple explanation I could give you. But one of the most important parameters that you need to evaluate bonds is on the rating. As I explained to you here, the coupon rate or the interest rate will vary as per the rating, and you have to decide for yourself which rating makes more sense for you personally. Lastly, there are a bunch of documents here that you can go through and make sure that you are comfortable with these documents. But now let me come back to the overview section and speak about some of the very, very important aspects of bond investing. So the first thing you see here is the issue size as well as collateral size. So let's click on issue size, and what we see here is that the total issue size of this company was 100 crores, out of which now Wind Wealth is bringing 16 crore for investments, right? Now, if you see the collateral size here, which is 1.1 times of the issue amount, what does this simply mean is that this company has kept 1.1 times of the issue size as the collateral in case the company defaults on its bond. So higher the collateral size, better it is, because it gives you added confidence that in case of defaults, you are likely to recover most of your money. If it is lower, it gives you less confidence, right? So hope issue size and collateral size is very, very clear to you. Now coming down, you see the bond rating I've explained to you. Now comes original bond tenure, which is 24 months. So this bond was issued for 2 years of maturity period. You can come down here and you can see here the allotment date was 29th of October 2024. Therefore, the bond will get matured on 29th of October 2026. But right now, if you're buying this in the month of March 2025, you have how many months left? So if you come down here, you can see your maturity left is 19 months because you're investing midway through this bond. And therefore, you're going to get interest for the remaining months that you can see here in the payment schedule. So you will get the next interest payment is coming out on 29th of April, which is 84 rupees. Now going further down, you will note here that this is a fixed coupon type. As I explained to you that the interest rate you're going to get is fixed. It is not going to change here. The bond is listed on BSE. That's very, very clear, self-explanatory. Allotment date, maturity date, I talked about. Now the coupon rate, which is the interest rate, which is fixed, is 9.9%. And it really depends on the credit rating, as I explained earlier here. But now comes the senior secure bond is the seniority type. What does this simply mean is that senior secure bonds, they get preference when it comes to getting the payments back from the company in case of defaults. So senior secured bonds are giving you more comfort. They are less riskier. Therefore, this is very, very good in my view. Then comes to another important price points here. One is the clean price and second one is dirty price. What is clean price? So if you click on here, you will know that this is the price, which is whatever is the remaining outstanding principal, right? Plus bonds premium or discount. So just to make it very, very clear, let's say the face value of a bond is 10,000 rupees. But because of, let's say, demand and supply, the bond is trading on the exchange at a price of 9,990 rupees, meaning that it is trading at a 10% discount. So in this example, 9,990 rupees becomes your clean price. Now, what is the meaning of dirty price here? Dirty price, again, if you click here, you will know that this also now takes into account the accrued interest. Let me now again talk about this here. You see the dirty price here is slightly lower than the clean price here, which is 9954 versus 9948. Here there is an accrued interest. So if I just come back here and show you the breakdown here of the investment amount, which is same as your dirty amount, you will see that there is an accrued interest which is negative in terms of 5 rupees 42 paise. Why is it the case? Because when you are buying this bond on the date of recording of this video, which is 27th of March, your next interest is only going to come on 29th of April. So it means for the next 2 days, you are losing some interest. There is an accrued interest. Therefore, it is giving you, considering that accrued interest to be minus 5 rupees, you are getting this at a slightly lower price because of you losing out on interest for 2 days. Again, I'm trying to make it as simple as possible for you so that you understand what is the meaning of dirty price, clean price. But ultimately, the bottom line is that all these prices, clean price, dirty price, accrued interest, gets factored into the purchase price calculation on WintWealth, and the net yield mentioned, that is 11%, factors all these price points. Now moving on to last couple of items, one of them is YTM, which is yield to maturity. If you click on this icon, you will know that the definition of yield to maturity is very, very simple, that it is considering the interest that you're getting paid to be reinvested back so that your effective yield or your net return is going to be better than the interest rate that you're getting. It's a very simple concept that you see in mutual fund XIRR return calculations. So the moment you get your interest back, and if you reinvest it back, your effective return is going to be slightly higher. And that is what yield to maturity means. And that's why you see this here as 11% versus the coupon rate of 9.9%. Again, if you see the yield to maturity before brokerage, that is even slightly higher in this case. So I hope the concept of yield to maturity is very, very clear to you, that if you are reinvesting back your payments that you are getting, then your yield will be slightly higher. Now coming to my last point, that on WintWealth platform, you can go and sell your bonds anytime. It's a simple process of clicking on proceed to sell and you are done. My last point on bonds, you can hold your bonds till the maturity time period, or if you bought it from Vint platform, you can go and sell it anytime, redeeming your money earlier than the maturity period. It makes bond investing via WintWealth flexible in my opinion. So in this video, I've covered a lot of details about bond investing. If you still have questions, doubts, let me know in the comments. I'll try to answer as many as possible. And more importantly, if you want me to make part 2 of this video, let me know in the comments. Based on your response, I may come up with part 2 of this video. I hope you enjoyed this video. If you did, press the like button. Let me know in the comments a simple thank you. You will find the link of WintWealth in the description or in the pinned comments. I hope to see you in my next video. Until then, keep rocking.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.